This banking system is on the edge of a collapse if interest rates start rising.
This week's specials with Miles Franklin Precious Metal Investments.
2021 Austrian Philharmonics for only $360 over spot. 2022 Noah's Ark silver coins, 1 ounce coins for $375 over spot, and 1/4 ounce coins for $245 over melt.
Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We're delighted to have this well-recognized returning guest. Alasdair MacLeod is the head of research at goldmoney.com. He joins us this Thursday, December 16, 2021. I don't know if this will be our last chance this year, but thank you for joining us in the middle of December here, Alasdair, and coming back on Liberty and Finance.
That's my pleasure, DK.
You've been with us pretty often, maybe once a month at least, over the last year and a half of a very bumpy road in markets and credit and banking and extraordinary actions by the keepers of the world's reserve currency and frankly all central banks. You've warned us that things are not looking good as far as the outlook for continued health of world currencies. You've cautioned us about the strains in the credit system itself, systemic strains, and you just wrote an article that was published today called The Credit Cycle and Zombies Downfall. Before we get to some of the principles that you're cautioning about in that article, could you bring us up to date? We saw the last 2 days gold and silver prices, silver I guess I'll mention in particular, down at lows that we haven't seen for over a year and a half. And then we saw today it's up like $1 from where it was at times yesterday. So we just had the FOMC meeting, the Fed Open Market Committee the last 2 days. Don't know if that's related to it. People are already asking me this morning. So could you give us your personal analyst's view of this short-term recent move in metals, but also then we'll get into the big picture thereafter?
Yeah, sure. I mean, the problem, I think, in the markets is a paper market problem. It's coming up to the start of the net stable funding ratio, Basel III regime being applied in London. And this is making the bullion banks want to close down their positions as much as possible. The level of open interest on COMEX has stopped falling and just begun to stabilize and maybe tick up a little bit. Deliveries of the December contract expiring, the futures contract expiring, have been really quite significant. So that's cleared out things a bit, very much at the expense of a system which is short of bullion. And at the same time, if you go and talk to the refiners and say, I'd like to buy, when can you deliver me some silver bullion? They say, well, at the moment, we're quoting middle of 2022. So if you want to have it in size, the physical isn't there at these prices. It's as simple as that. It's also true of gold, though the queue, if you like, for physical bullion from the refiners, gold bullion, is not as long as it is for silver. Silver is interesting because, and this is something which I think people are just ignoring completely, and that is the commercial demand for silver over the next few years is going to be massive. Why? Because the whole world is moving into this environmental, thing about doing away with fossil fuels and so on. And if you want some sort of marker as to what's happened to other, if you like, environmental related commodities, just look at uranium. They've more or less doubled this year. The difference between uranium and silver, apart from the obvious characteristics, is that there isn't a paper market in uranium. Uranium is a market where prices are basically struck between supplier and user. There is no market for it, if you like, in the paper sense. So that's doubled. What's silver done? It's fallen from a high of $30 down to, at one stage it was 21.5 or whatever yesterday. So, quite clearly, it's the paper market that has screwed the price. So that I think is something it's now happened, and I think It's out of the way. I don't think there's anything really, now that the FOMC statement has come out and the other statements come out from the other two major central banks, I don't think there's anything the bullion banks can do to suppress the price from here. So I think it was the relief of that situation that has led to a good jump in the price of gold today and a good jump in the price of silver. I noticed also that palladium's jumped something like 8 or 9%. I mean, that's been a very strong market. And not just palladium. I mean, copper is up 3% and so on. So there's been quite a bit of a turnaround. Now, this is interesting because if you look at this sort of broader base metals, then, like copper and so on. I mean, what this is telling us is that the industrial users they've seen the situation with the FOMC and all the rest of it. And so their thinking is, well, they're not really tackling inflation as much as perhaps they should. So perhaps we ought to go into the market and buy copper. I mean, I talk to people in the copper market and, they're sort of telling me that demand isn't as high as perhaps they thought it would be. They look at the demand in China. I mean, quite a lot of China, industrial China, is locked down because of this new variant and the COVID variant. So, you would think that with copper demand being sat on, if you like, by COVID, that the copper price would fall. But no, it's rising. And of course, the thing that people don't understand is it's not necessarily the copper price rising. It's the value of this, the purchasing power of the currency that you're pricing it in that's falling. And this, I think, is the important thing, which nobody in the commodity markets, if you read the commentaries, nobody in the commodity markets actually really understands. If you have got a grasp of what's happening to money and currencies, then you can understand it. And I think that's the importance of these podcasts that we've been doing over the last year or so.
You've warned us for some time about the slow awakening of the populace to the realization that it's the currency that's failing, not so much these various real assets that are increasing. You're seeing that playing out, and it affects many different aspects of the economy and of our financial world. But there's been signposts that you've pointed to that in this sort of decline of the currencies, and it seems to be these sign markers are passing faster than ever before. One area of strain that you've pointed out is in the banking system. You just wrote an article called "The Credit Cycle and Zombies' Downfall." Could you talk to us about what were the main findings that you want to make sure that people understand about the plight of the where we stand right now at the end of this crescendo of a credit cycle, and what state the banks are in, and what that all has to do with our futures?
Yeah, well, I'm sure that some of your viewers will know or will have heard of the Austrian business cycle, which basically is, it's the sort of ups and downs. You go from growth to recession and so on and so forth. I look at it slightly differently because the root of it, rather like inflation, is a monetary, is basically a monetary phenomenon. The business cycle is actually the result of a credit cycle. And so it's important to understand what happens to bank credit, to know how it is created, and to know also that bankers are human. And like anyone investing in assets, which is really what bankers do. I mean, they're dealers in money. They're dealers in currency, if you like. On one side of their balance sheet, they have assets. So those assets, they can be loans to other people, or they can be bonds, or whatever it might be. Anything. So they're managing assets, if you like, in the broader sense. So they've got exactly the same emotions, if you like, as ordinary people, but in a specific sense. So when they're worried about economic conditions, then risk is uppermost in their mind. When they are more enthused about economic conditions, then they want to make as much money as they possibly can. And the way you do this with the modern banking system is you create credit out of thin air, which is easy enough to do. Banks have been doing it ever since the goldsmiths, if you like, took in money from the general public on the understanding that if they were going to pay a dividend of 6% per annum to depositors, then the goldsmith takes that money and uses it as if it is his own. In fact, it was his own money. He just has a liability to the depositor. And that is basically the way in which modern banking works. So this means that a bank can expand its balance sheet without using its own capital. And this is the key thing. It uses other people's money, depositors. And so what really matters in terms of this sort of perception of risk and perception of return, call it, sort of fear and greed, if you like, is the ratio of the size of the balance sheet to the shareholders' equity in the bank. And in a very conservative situation, let us say, coming out of a recession, banks would typically have a balance sheet ratio of assets to equity of somewhere around sort of maybe 5-6 times that sort of multiple. And what this means basically is that a 1% margin on interest between the banks borrowing from depositors and lending out to their borrowing customers, 1% becomes 6%. This is nice stuff. So obviously, you can understand that when a banker is more confident about the trading conditions in the economy as a whole, then his asset to equity ratio is going to creep up a bit. And if you look over history, you get the sort of cycle, if you like, of expansion and contraction lasting roughly 10 years. This has been the case from the middle of the 19th century. It still sort of happens today, but it's less visible because central banks are printing currency as well. We have pure fiat money as opposed to something that pretends to be on a gold standard. So you can see that it's not necessarily quite so visible. But what has happened is that having rescued the banks from the Lehman crisis in 2008, 2009, the level of balance sheet gearing in the banks has just actually increased and increased. And we now have a situation where, if I look at America, the asset to equity ratio of the banks there typically is somewhere between 10 and 12 times. Now, that's sort of quite high. That's rich, but it's in terms of the global context, there are other banking systems which are considerably more exposed to this sort of greed, if you like. And therefore, when things start going wrong, fear is going to be uppermost in their mind. And the worst of the lot, quite honestly, and I'm sorry, I'm looking to the side because I'm just looking at my figures, is the Eurozone. Would you believe that the French bank, Groupe Crédit Agricole, has a leverage of 30 times? Its assets are 30 times its equity. So you can see that, all you need is a decline of, sort of 3 and a bit percent, maybe 3.5% to wipe out all that bank's equity. So, so you begin to think, well, where are their assets invested? Is this sort of loaned to Peugeot, for example, or, the government or whatever? And if it's in bonds, just think, if Crédit Agricole have got not just huge quantities of bonds, but bonds which aren't just, sort of maturing in 1 year, but bonds which might be maturing, say, between 5 and 10 years, then the losses from a rise in interest rates is going to be catastrophic for that bank. Now, these, the banks which I've got put on the table in that article are only the global systemically important banks. If you look at other banks in the Eurozone, there are over 1,000 other smaller banks in the Eurozone. Now, some of them, I'm sure, have got even more gearing than the GSIBs. Deutsche Bank is 22 times, Paribas 21 times. Unicredit, which is the Italian banking conglomerate is 15 and a half times. But you see, the other question is how much of this is actually bad and doubtful debts? Now, we do know that what's happened in UniCredit was, and its peers in Italy, was there was a huge level of non-performing loans, which suddenly miraculously seems to have disappeared. Why has it disappeared? And I can tell you what's happened is that the local regulator in Rome has turned round, or Milan, has turned round and said, those non-performing loans, I'm going to call them performing. So you can use them as collateral to lend to other people in the repo market. And what's happened is that those loans have now disappeared into the Target 2 system because, you know, a UniCredit, let's say, can package up all these sort of bad and doubtful collateral and say to UniCredit, say to the Banca d'Italia, I want to borrow, or I want to, through the repo market, the repo facility, whether it's overnight or 2 months or whatever, it really doesn't matter. But I want X billion euros of cash, which comes at 0%, by the way, 0%. So you get cash for free in return for depositing all this doubtful loan rubbish, collateral. That's what's been going on. And here we have a system. I mean, what's happened with the repo market, and I didn't mention this in the article, I mentioned it in an earlier article, but what's happened with the repo market is that in the Eurozone, the total repo market is now over 10 trillion euros. Now, we were getting very excited when we saw the repo market in America go to $1 trillion. We're talking more than 10 times that in the Eurozone market. And what this tells us is that zero interest rates has corrupted the market such that virtually the entire liquidity in the banking system is now obtained through repos. Now, you've got to think, what happens when interest rates rise? Well, it's quite clear. What will happen is that those repos will be unwound, or a substantial number of them. So you're going to get a contraction of bank credit. Now, imagine that you're a banker, a commercial banker somewhere in the Eurozone, and you can see that bank credit is contracting. In other words, credit is being taken out of the economy. You're finding that the ECB is having to push more money into the economy to counteract the bank credit which is contracting. And you can see that the conditions are beginning to fall apart. I mean, it's a good old-fashioned contraction of bank credit. It's the downside, if you like, of the bank credit cycle. These guys know it. They've seen it before. What are they going to do? Are they going to sit there and just sort of watch it and say, oh, well, you know, we're 30 times assets to equity, but don't worry, the Banque de France will come and rescue us, you know. Come on, they don't do that. Nobody wants to be rescued. Basically, shares will be wiped out. And the thing that's interesting is that if you look at the shares of all the G-SIBs without there is one exception, actually, the Ing Group NV, which is the big Dutch bank. But otherwise, all the other G-SIBs, their shares are trading at substantial discounts to book value, which basically is a vote from the market saying that, you know, these shares are just too risky to hold. I mean, you would think that if a share is, say, standing at a 40% discount or 50% discount to book value, that, that would indicate that, you can buy €1 for 50 cents. Why not? The answer is the risk that comes with it from this excessive gearing. And it's not just the Eurozone, but I mean, I look at Japan and the asset to equity ratio there of the three G-SIBs. We're looking at 20.4, 24.1, 20.3. China is less. That's more in line with America, looking at sort of 11s, and the agricultural bank is slightly higher at 12.3. But the interesting thing is that all the shares of their four G-SIBs are trading at substantial discounts to net asset value. And I think that's, I don't think it's because everyone thinks they're going to go bust. I think it's just nobody sees that, you can actually make any money out of it. And these are state-controlled banks anyway. I mean, the state basically owns them. So the share prices are pretty irrelevant. In the UK, we've got Barclays, HSBC, Standard Chartered. I mean, Barclays is on 20 times asset to equity ratio. And again, a big discount to net asset value. The worst discount of the lot is Standard Chartered. They've got asset to equity of around about 15.6 times. HSBC is 14.6. Now, those two banks, as UK banks, obviously have risk because so much of their business and profits is in China and Hong Kong. So, there's a story there within the whole story. Canada, RBC is 18.7 times assets to equity. TD Bank, 18 times. Switzerland, UBS, and Credit Suisse are both 18.8 times. Now, one of those banks is a substantial discount to book value, which is Credit Suisse, and UBS is a small premium. So, this banking system is on the edge of a collapse if interest rates start rising. And so what do we see? We see that the major central banks are beginning to raise interest rates. We've had it sort of started in America with tapering, and then tapering being sped up in lieu of interest rates. But I mean, that interest rates are going to be raised. They will have to be raised because the purchasing power of the dollar is going down. It needs to be stabilized at some stage. In the UK today, we had a 15 basis point rise in the lending rate. I mean, I don't know what planet these guys are on. I mean, the problem is far bigger than something that can be solved with a 15 basis point rise in the bank's lending rate. So all I can say is that there will come a time, and it's very, very shortly it will be upon us. There will come a time when markets begin to fear the consequences of rising interest rates and what it is likely to do to the banking system. And I would just add one sort of thought, which might give us a little clue on timing. I mean, China is not quite in the same position as all the other banks yet. They have got the collapse of Evergrande. They have got various other property developers. Share prices there definitely showing they're in trouble. One of the characteristics of a turnaround in the bank credit situation is when things start going wrong in the property market. I mean, we saw this with the Lehman crisis. I saw this back in 1973 when a raise in interest rates collapsed the whole property market in London. I remember shares in Town and City falling by 90% in a month. And that was a blue chip developer in London. It took out the secondary banking system, what we refer to as the secondary banking system, which basically were the specialist property lending banks. I mean, they all basically collapsed. That was very, very nasty at the time. And so, one of the things I do look for is what's the property lending situation? So we can see that in China, this is maybe sending us a bit of a signal, but it's not just property. I mean, if you go back to 2000, you had this sort of ramp up of the dot-coms, and then you had the collapse afterwards. And I think I'm right in saying that the S&P 500 lost a good 50% of its value in about 18 months. So that's the other thing. This time round, I think for all the banks other than China, we'll put that to one side, I think is the unwinding of speculative investment in financial assets. And if you want an example of just how crazy the whole thing has gone, just look at cryptocurrencies. I mean, there are thousands of them now, all vying for attention. Look at things like these non-fungible tokens. I mean, this is just pure speculation. It is the biggest level of speculation I think ever recorded in human history. So the collapsing of that bubble is not going to be a light-hearted affair. It's going to be extremely serious.
when you've warned us in the past about strains on the banking system, the high gearing of the banks, the market not buying it in the sense of this low price to book value ratio of so many banking shares, it seems that the public, the investing public, is like the last always to find out about these sort of things. Many people are still delighted with decades and decades of advances in the major equity stock market indices and so on. When do you think the evidence of what's going to happen becomes inescapable even to the common person? Or by then is it so far too late that all the smart money has positioned itself and there's just the middle class or whoever's left as investors are left holding the bag?
I don't think it's a question of just the middle classes being left holding the bag. I think that's a currency issue rather than a financial asset issue, because the whole system, everyone has bought into this sort of Keynesian idea that, low cost of capital is good. It's not. I mean, capital is meant to be scarce. And if capital is, sort of freely available, then actually all that happens is you just get massive speculation and it builds until the bubble pops. It's really as simple as that. The key to the timing, I think, is very simple, and that is the interest rate situation. You see interest rates beginning to rise. What I would say is that it will start undermining the values of financial assets. I mean, obviously, if you get a rise in interest rates, bond yields will start rising along with it, which means that there will be portfolio losses on bonds. And also, in sort of by comparison, the values of equities, which base themselves on the return from bonds, they will be undermined as well. And given the relative volatility between bonds and equities, the losses in equities could be quite serious, potentially serious. Then, of course, what happens is that when the banks start realizing that the tide has turned, what they start doing is they start liquidating the sort of collateral assets, which are mainly financial nowadays. I mean, okay, with mortgages, they've got title deeds in your home, but, basically, we're talking financial assets. And they will just sell these. I mean, if the situation is uncovered, I mean, the bank that it sort of takes them, tries to sort of help its borrowing customers, I mean, it will kill it. The bank basically will die if it does that. It cannot afford to take, a sort of, if you like, a moderate line in this. It has to act, and it has to act quickly. When you're geared that much, I mean, America is not quite so bad, but just imagine, you're Deutsche Bank, and the DAX index is beginning to go down, and you've got customers who, you're sort of you're looking at the cover of it, and, you write to the customer or you email the customer and you say, can you top up the collateral? And the customer comes back and says, sorry, you've got all my collateral already. And by the way, I'd like to borrow a bit more. What happens? Deutsche Bank starts foreclosing. So, and it sells the collateral. And this is what happens. And this was the thing that Irving Fisher discovered about the collapse of Wall Street in 1929 to 32 and the way the banks went bust in the wake of it. It was all due to the collapsing value of collateral. So you're going to get, I mean, the idea that you can sort of sit on a situation and say, if, let us say, these shares go down 20%, they will represent extremely good value. If you say that, you've missed the point. The point is that there's a tsunami of stock overhanging the market by virtue of the fact that the market is beginning to fall. So I think you could find the fall in markets is very, very sudden. And the time to get out of it is before it happens, not while it is happening. Interest rates will give you the timing on this. And people's understanding of how high interest rates might have to go will give you timing on this as well. I mean, if looking at the British situation, if the answer is that 15 basis points will put the whole thing right, fine. Now, the Bank of England obviously believes that a 15 basis point rise might be enough. I mean, they will hold a little bit of firepower and maybe. So you can see that actually the Bank of England is only really prepared to raise interest rates by, say, 0.5% or something like that, and will basically try and talk its way out of the situation. I mean, this is nonsensical. But as soon as the market begins to realize that actually, this inflation problem is not going to go away. It is going to get worse. Why? Because the money is being printed to do it. What's going to happen? I mean, are they going to stop printing money? That's what they should do. No, because the government needs the money, one. And two, they need to print money in order to rescue the banks, rescue the system, rescue all the zombie companies, which start falling over when you got sort of, an extra 1 or 2% on their borrowing costs. And I mean, zombies start falling over not just for that reason, but they start falling over because they rely on the banks for their working capital. And the banks start saying, well, look, we're not prepared to continue to make working capital available. Or they might turn around and say, well, your working capital facility of 5 million, we're going to cut down to 2.5 million. So this is the environment which we're now moving into, and it's going to be devastating. I mean, the whole point about financial assets is that there is so much speculation in them. And the point about speculation is that people in the market don't realize that it's a market of pure speculation. This always happens. I mean, just read the history of every financial bubble, and you can see this time and time again. Well, folks, we are here yet again, and this time we are here in greater style than we have ever been before. This is worse than the South Sea bubble. It is worse than the Mississippi bubble. It's worse than tulip mania. It is global. This is really an extraordinary situation.
For people who are become accustomed for a generation or more, 2 generations, to progressing upwards stock markets, that sort of thing, faith that somehow the central banks are going to keep kicking the can down the road, keeping things rolling, keeping the wheels on the cart. What do they need to know? I mean, you've pretty well laid it out here, but what do they know about how serious this can be for an ordinary family's financial situation and for all of us?
If you look at, say, equities, I mean, for them to lose 90% of their value on average, I mean, that's basically what the Dow did between September 1929 and July 1932. I think that we've got a similar situation to that. I would say that the amount of speculation at the top, which is where we are, is greater than it was in the late months of 1929. So that is as far as equities are concerned. But the problem we have now is that in those days, you had a gold standard which actually worked. I mean, you could actually take your dollar notes, or you could go to your bank, put in federal dollars, and get gold coins out. You can't do that now. And, it was fixed. So now you've got this wonderful elastic paper money, which has got about as much credibility, really, as the good old-fashioned paper mark of 1923, the Venezuelan currency today, the Zimbabwean currency. It's exactly the same. It's got no backing whatsoever. The only backing it's got is the full faith and credit of your government. And when you find that asset values for financial assets collapses, and you find that the central bank, the Fed, can't stop it, and the central bank, in terms of the Fed, is deploying unlimited new paper to rescue banks from failure, to try and protect depositors, whatever. I mean, it is vitally important for the Fed to rescue the banks. You cannot allow any bank to go bust now. This is not 1932. No, this is 2021, 2022. These banks have got to be rescued. How are they rescued? Money is printed. So not only do you have the problem of collapsing asset values in financial assets, but you also have the problem of the collapsing purchasing power of the currency. So where do you go? You've got to go into something real. And there are two things which are real in broad sense. One is suitable non-financial assets, which probably include physical property. But what physical property has got to get over is the problem that it is priced on the basis of mortgage borrowing. So when interest rates rise and they begin to reflect the declining purchasing power of the dollar, they will rise and they will rise and they will rise. The affordability of anyone trying to get a new mortgage to buy a new house or whatever basically will tell you that certainly in real terms, house prices are going to go down and down and down. But it might be better than holding paper money. And if you have got something which you can use to acquire property at the bottom of this mess, then brilliant. And there's only really one thing you can have under those circumstances, and that's real money. And real money is physical gold and physical silver. And on your podcast before, I've told the story of 1923 Germany when, for $100, which was the equivalent of just less than $5, 5 ounces of gold at that time, because the rate was 20.67 dollars to the ounce. So just under 5 ounces of gold bought you a 6-bedroom house in a swanky part of Berlin. That was what the currency collapse did to asset prices which you would have thought would be, a good hedge in this situation. By far the best hedge is gold and silver, physical gold and silver, nothing paper. The interesting thing about property is that in that collapse, it became apparent to people who thought that property was a store of value, store of wealth, that actually these are depreciating assets. Because if you had a portfolio of, say, properties to let, you've got the problem that your income, your letting income, is collapsing in real terms along with the collapse of the currency. Because you can't just go and sort of renew it every day at a higher level. It doesn't work like that. And also the other thing is that the cost of maintaining the property was going through the roof. So these were liabilities; these weren't assets. The world looks a very different place when you get a currency collapse. And I think that anyone who is interested in trying to survive, keeping some of their wealth intact in this situation, I think better go and study and think about it very, very hard.
Well, Alasdair, for people who want to follow up your work, you write every week, multiple articles. You've told us in the past, we'll put a link in the description of this video of the article we're discussing, but just remind people the cycle that you're on in terms of your publishing so they can stay up with your latest work.
Yes, of course. Basically, I publish an article on economics, sound money, every Thursday, and that's released sort of afternoon EST or midday EST on Thursdays. So you go to Gold Money Research Insights and you'll find the latest articles there. And I do a market report covering precious metals, which is published on the following day, the Friday. And that, there are lots of market reports on them, but, I try and make it sort of slightly different. So that might be of interest to your viewers as well.
Well, as always, Alasdair, people look forward to your visits here because you as a former bank president, as an analyst who has contacts across the banking industry, and you bring a perspective that is rare, and we appreciate it to no end here. Just always grateful for your presence on Liberty and Finance.
That's my pleasure, dear.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.